It feels like every day there's a new risk, a new headline, some new thing you got to worry about in the business world, right?
Yeah, it really does. And it's tough to cut through all the noise and figure out what really matters and what you can actually do about it.
Right. So that's what we're going to try to do today. We're going to take a deep dive into enterprise risk management, or ERM. But we're not just talking about it in general, we're really focusing on two key areas: insurance and information technology. We've got this great article that lays it all out. We're going to break it down for you. So basically, we're going to take all that complicated stuff and turn it into something you can actually use.
Exactly. And what makes this so interesting is that while the underlying principles of ERM are pretty universal, how they actually play out and the specific challenges you face, those can be totally different depending on the industry.
Right, like what works for a tech startup isn't necessarily going to work for a giant insurance company.
Exactly. So we're going to look at insurance first, which is obviously an industry that's all about managing risk. And then we'll switch gears and dive into information technology, where the threats are constantly changing and evolving.
So by the end of this, you'll have a solid understanding of how ERM works in both of these sectors. Sounds good.
Sounds good to me. Let's get started.
Okay, so first up, insurance. I mean, it kind of goes without saying, but their whole business is about risk, right? They literally sell it.
Yeah, they assess it, they price it, they manage it. It's the core of what they do.
So even though ERM concepts can apply broadly, the insurance world has its own, special flavor, especially because their whole model is built around taking on risk through things like underwriting.
Right, they're taking on the risk that something bad will happen, like a car accident or a house fire. And then they use the premiums they collect to pay out claims and to invest.
And managing those investments is another huge piece of the puzzle for them.
Absolutely. They need to make sure they have enough money on hand to cover those potential claims down the road. So for insurers, their main areas of risk exposure really come down to, like you said, underwriting and how they manage their investment funds. But the article digs into some extra considerations that are worth looking at.
Okay, so the first one is how insurers categorize their risks.
hmm
They have a really structured approach to it, right?
Yeah, they do. It's like a detailed risk map. And the article actually gives us a table that breaks it all down.
Oh, perfect. So let's take a look at that table.
Okay, so the first thing to notice is that they have a lot of the same categories as the financial services sector. Makes sense since there's so much overlap there.
Right, they're both dealing with money and risk, just in different ways.
Exactly. So you see categories like strategic risk, which is all about the potential impact of, well, their strategic decisions. Things like mergers, acquisitions, new products, stuff like that.
Okay, makes sense. And what about credit risk?
That's the risk of losing money if someone they've lent money to or are otherwise financially exposed to doesn't pay them back.
Ah, so like if a company they've invested in goes bankrupt.
Precisely.
Hmm.
And then there's market risk, which covers things like changes in interest rates, currency exchange rates, even the prices of commodities, basically anything that could cause the value of their assets to go down.
Got it. So a lot of external factors that can affect them.
Right. And then you've got liquidity risk.
That one sounds pretty straightforward, like making sure they have enough cash on hand to meet their obligations, right?
Yeah, basically. And for insurance companies, that's super important because they need to be able to pay out claims when they come due.
Makes sense. What's next? Operational risk.
Yep. This is a big one. It covers all sorts of internal things that could go wrong. Human errors, system failures, fraud, even things like natural disasters or terrorist attacks that disrupt their operations.
So anything that messes up their ability to do business.
Exactly. And if you look at the table, you can see how detailed they get with this. They break it down into all these subcategories like internal fraud, external fraud, employment practices, client issues, damage to physical assets, business disruptions, even problems with execution and process management.
Wow, that's a lot to keep track of.
It is. And here's where things get even more interesting. They specifically call out insurance risk as its own distinct category. Sometimes it's called underwriting risk.
Which makes sense, right?
Yeah.
Since that's their bread and butter.
Exactly. It's the risk that they'll have to pay out more in claims than they predicted. But here's the catch-in. The article points out that there can be a lot of overlap between insurance risk and operational risk.
Okay, how so?
Well, think about it. Let's say a claim arises because the insurer didn't follow its own underwriting guidelines, or maybe the actuaries made a mistake when calculating the risk, or maybe there was just bad documentation. In those cases, is it an insurance risk or an operational risk?
That's a good point. It's kind of both, right?
Right. The claim itself is an insurance risk, but the underlying problems that led to the claim might be operational in nature. And that can make things really tricky for risk management.
Yeah, because you have to figure out not just what happened, but why it happened.
Exactly. So the article then moves on to Solvency II and national regulations.
Okay, so now we're getting into the nitty-gritty of how the insurance industry is regulated.
Right. And the main goal here is to make sure that insurance companies have enough money to cover their potential losses and to protect policyholders.
So it's all about stability and making sure the system doesn't collapse.
Exactly. And Solvency II is the big regulatory framework in the European Union. And it's pretty influential globally, too. A lot of other countries have adopted similar standards.
Okay, so what's the deal with Solvency II? How does it actually work?
Well, it's structured around three pillars. Think of it like a three-legged stool.
Okay, I like that analogy. So what's the first leg?
Pillar 1 is all about quantitative standards. This is where they set the solvency capital requirement, or SCR, which is the minimum amount of capital an insurer needs to hold.
Okay, so that's the bare minimum they need to have in the bank to cover potential losses.
Right. And they also have the minimum capital requirement, or MCR, which is a lower threshold. If an insurer's capital falls below this level, regulators will step in and take action.
Got it. So those are the financial safeguards. What about Pillar 2?
Pillar 2 is more about the qualitative aspects. So things like governance structures, supervisory oversight, and the own risk and solvency assessment, or ORSA.
Hold on. ORSA, that one sounds interesting. What's that all about?
So ORSA is basically the insurer's own internal risk management process. It's how they identify, evaluate, and manage all the risks they face, and then determine how much capital they need to hold.
So it's not just about meeting some external regulatory requirement. It's about actually understanding and managing their own risks.
Precisely. It's an ongoing process, not just a one-time check-in.
Okay, that makes sense. So what about the third pillar?
Pillar 3 is all about reporting and transparency. Insurers have to disclose information both to the public and to their regulators.
So everyone can see how they're doing and what their risks are.
Exactly. They have to publish a solvency and financial condition report for the public, and they have to submit a report to supervisors for the regulators.
Got it. Transparency is key. Okay, so that's Solvency II. What else does the article cover in terms of insurance regulations?
Well, it talks about how insurers can sometimes use their own internal risk models to calculate their capital requirements instead of just relying on the standard formulas.
Okay, so they're allowed to have their own in-house methods for assessing risk.
Yeah, in certain cases. And it makes sense because some insurers have really unique and complex risk profiles. But there's a catch.
There's always a catch. What is it?
It's called the use test. Basically, the model can't just be some theoretical exercise. It has to actually be used in the insurer's day-to-day operations. Like, it has to be part of their decision-making, their governance processes, and their capital allocation.
Oh, so they can't just create this fancy model and then stick it on a shelf somewhere.
Nope, it has to be a living, breathing part of their risk management system.
And how often do they have to calculate their capital requirement using this model?
As often as they use it for other key management functions.
Right, so it needs to be integrated. Okay, so that's how insurers can use internal models. What else is there?
Well, the article has this really helpful case study from Bupa. It shows how a real-world insurer puts these principles into practice.
Oh, perfect. Let's dive into that.
Okay, so Bupa listed their top 5 risks, ranked in order of the solvency capital they're required to hold against them.
Okay, makes sense. So what was number 1?
Property risk. They've got a lot of property holdings, and the value of those properties can fluctuate. So they try to mitigate that risk through geographic diversification.
Ah, so they don't put all their eggs in one basket.
Right. Next up is insurance risk itself. That's the risk associated with their core business, setting premiums, underwriting policies, and paying out claims.
Okay, that's their bread and butter, so it makes sense that it would be high on the list.
Yeah.
How do they manage that?
They use a bunch of strategies. They offer a lot of short-tailed products, which means they can adjust their pricing more quickly if the market changes. They build a prudence margin into their reserves, so they have a buffer. And again, they use geographic diversification to spread the risk.
Smart. What's number 3?
Currency risk. Fluctuations in exchange rates can really impact their bottom line, especially since they operate in multiple countries.
Right, that makes sense. What do they do about that?
They use hedging strategies to protect themselves, and they also try to match their assets and liabilities in local currencies as much as possible.
Ah, so they're trying to minimize their exposure to those currency swings.
Exactly. Number 4 is credit spread and counterparty default risk.
Okay, break that one down for me.
Basically, it's the risk that the value of their bonds will go down or that a counterparty will fail to meet their obligations. Like if they've lent money to someone and that person can't pay them back.
Right, I see. So how do they manage that?
Well, they pointed out that their bond portfolio is relatively small and mostly invested in high quality investment grade bonds. And they also impose limits on how much they can lend to any single counterparty.
So again, it's all about spreading the risk.
Exactly. And finally, number 5 is operational risk. For Bupa, this includes things like conduct risk and clinical risk.
Right, so they're thinking about things like making sure they're complying with regulations and that they're providing high-quality care.
Exactly. And they manage this through internal controls, strong governance frameworks, clear risk policies, and careful oversight of clinical quality.
Okay, so they've got a pretty comprehensive approach to risk management. It's helpful to see how a real company puts all this into action.
It is. So now the article shifts gears a little bit and talks about why organizations buy insurance in the first place. And it breaks it down into 3 main categories.
Okay, what are they?
The first one is balance sheet and profit and loss protection. This is basically coverage for the organization's own assets and earnings.
So if something happens to their property or their business is interrupted, they're covered.
Right. The second category is fulfilling mandatory legal and contractual obligations.
So like if they're required by law to have certain types of insurance.
Exactly. Or if they've agreed to provide certain coverage as part of a contract.
Okay, so that's about meeting external requirements.
Right. And the third category is protection of employee assets. This is things like life insurance, health insurance, disability insurance.
Got it. So those are the 3 main reasons why organizations buy insurance.
Exactly. And the article goes into more detail about the specific types of insurance that fall under each category.
Okay, let's talk about those.
All right, so under mandatory obligations, you have things like employer's liability insurance. That protects the employer if an employee gets injured or sick on the job.
Right. That's a big one, especially for companies with a lot of employees.
Definitely. And then there's public liability insurance. That protects the company if someone gets injured or their property is damaged as a result of the company's operations.
So like if someone slips and falls in their store.
Exactly. Then you have motor third-party insurance, which is required in most countries if you drive a vehicle.
Right, that covers damage or injury you cause to other people or their property while driving.
Yep. And then there's product liability insurance, which protects the company if someone is injured or their property is damaged by a product they manufactured or sold.
That one's especially important for companies that make or sell anything that could potentially be dangerous.
Absolutely. And finally, there's professional indemnity insurance. This is for professionals like doctors, lawyers, and accountants who could be sued for negligence or errors in their work.
Okay, so those are the main types of mandatory insurance. What about balance sheet and profit and loss protection?
So in that category, you've got business premises insurance. That covers damage to the company's buildings and property.
Right, like if there's a fire or a flood.
Exactly. And then there's business interruption insurance. That covers lost profits and expenses if the business has to shut down temporarily because of an insured event, like a fire or a natural disaster.
Oh, that's an interesting one. I hadn't really thought about that before.
Yeah, it can be really important for businesses that rely on a physical location to operate. And then there's asset protection insurance. This covers a wide range of things like theft, loss of cash, damage to goods in transit, credit risk, and even employee dishonesty.
So basically anything that could harm their assets.
Right. They also might have motor accidental damage insurance, which covers damage to their own vehicles.
As opposed to the third-party insurance we talked about earlier.
Exactly. And then there's terrorism insurance, which covers losses from terrorist attacks.
And I imagine that's becoming more and more important these days.
Unfortunately, yes. And finally, there's key person insurance. This is a really interesting one. It covers the financial loss to the business if a key employee, like a CEO or a top salesperson, dies or becomes disabled.
Wow, that's a really specialized type of insurance.
It is. But for some businesses, it can be really important. Okay, so that covers the balance sheet and profit and loss protection category.
All right, so now on to the last one. Employee benefits.
Right. So this category mainly includes life and health insurance.
Which can cover a whole bunch of things, right?
Yeah, like life insurance, critical illness insurance, income protection, private medical costs, permanent health insurance, personal accident insurance, and even travel injury coverage.
Wow, that's a lot.
It is, and it really highlights how important this type of insurance is for both employers and employees.
Right, because it helps protect employees and their families from financial hardship.
Exactly. And then the last type of insurance in this category is directors and officers liability insurance.
That's the one that protects company leaders from lawsuits, right?
Exactly. It covers their personal assets if they're sued for things like mismanagement or breach of duty.
Got it. So those are the main types of insurance that organizations buy. What else is there to know about insurance and ERM?
Well, the last thing the article talks about is captive insurance.
Okay, I've heard of that, but I'm not really sure what it is.
Basically, it's when a company creates its own insurance company to insure itself.
Really? So they don't buy insurance from a traditional insurer.
Well, sometimes they do, but they also use their own captive insurer to cover certain risks.
Why would they do that?
There are a few reasons. Sometimes it's more cost-effective to self-insure for certain risks, or maybe the traditional insurance market doesn't offer the type of coverage they need.
So it gives them more control and flexibility.
Exactly. And often the captive insurer will act as a reinsurer for the parent company.
Okay, so they're essentially providing a second layer of protection.
Right. It's like having your own in-house safety net.
Makes sense. Okay, so we've covered a lot of ground on insurance. We talked about how they categorize risk, the regulatory landscape with Solvency II, internal risk models, reasons for buying insurance, and even captive insurance.
We've got a pretty good handle on the insurance side of things. Now it's time to switch gears and dive into the world of information technology.
Yeah, let's do it. And this is an area that's just exploding in terms of risk, right?
Absolutely. I mean, just think about how much we rely on technology these days. Our businesses, our personal lives, everything. And the more we rely on technology, the more vulnerable we become to cyber attacks.
That's like every day there's a new data breach or some new kind of malware.
It's crazy, right? It really feels like a constant uphill battle.
It does. So the article highlights how organizations are becoming more and more reliant on cybersecurity as they digitize their operations. And honestly, it feels pretty overwhelming to keep up with all the latest threats.
Yeah, I can see how it would feel that way. And the article dives into some key cybersecurity trends that are driving this feeling.
Okay, what are they?
Well, the first one is the demand for instant access to data and information platforms.
Right. Everyone wants everything now.
Exactly. And that creates more opportunities for cyber criminals to exploit. If systems aren't designed with security as a top priority, that instant access can turn into an instant vulnerability.
Makes sense. What's the next trend?
The sophistication of cybercriminals is constantly increasing. They're using advanced technologies like AI and machine learning to launch more targeted and effective attacks.
It's crazy to think that the same tools that are being used to protect us are also being used against us.
Yeah, it's a real arms race. And then there's the regulatory environment, which is constantly evolving.
So companies have to keep up with all these new rules and regulations on top of everything else.
Exactly. And then, of course, there's the ongoing shortage of skilled cybersecurity professionals.
Yeah, I've heard that's a big problem.
It is. The demand for these skills far outstrips the supply, and that makes it really tough for organizations to build and maintain strong security teams.
So it's a perfect storm of challenges. No wonder people feel overwhelmed.
Right. So, with all this in mind, mitigating cybersecurity risks has become a top priority for IT professionals. McKinsey, as the article mentions, emphasizes the critical need for continuous monitoring of the cyber environment and a systematic approach to adapting security defenses.
So basically, you can't just set it and forget it. You have to be constantly vigilant and ready to adjust.
Exactly. And the article talks about how more and more organizations are adopting a three-step process to manage cybersecurity risks.
Okay, I'm all ears. What are the 3 steps?
The first step is verifying their cyber controls, especially any new ones they've implemented.
Okay, so making sure that their defenses are actually working. How do they do that?
They conduct technical assessments to see if their controls are effective against current and emerging threats.
Makes sense. What's step 2?
Reassessing their overall cyber strategy. They need to make sure it incorporates new security capabilities and methodologies.
So they're constantly updating their game plan based on the latest threats.
Exactly. And the third step is to implement a structured program to regularly evaluate their cyber strategy, their tools, and their processes.
So it's an ongoing cycle of assessment and improvement.
Exactly. They're trying to stay ahead of the curve by constantly adapting and evolving.
Yeah, similar to the insurance industry, which has Solvency II, the IT world also has its own set of standards and frameworks to help manage these risks, right?
Right. The article specifically mentions the ISO 27000 series.
ISO 27000. That rings a bell. What is it exactly?
Well, it's a globally recognized set of standards for information security management. Think of it as a comprehensive framework for implementing best practices in information security.
Okay, so like a blueprint for building a secure system.
Exactly. And within the ISO 27000 series, there's a specific standard called ISO 27001, and this one's particularly important
Why is that?
because it's widely used by organizations worldwide to build, implement, maintain, and continually improve their information security management systems, or ISMS.
ISMS, got it. So that's what they call their overall security system.
Exactly. And ISO 27001 also helps them assess and manage security risks associated with third-party vendors.
Ah, so it's not just about protecting their own internal systems, but also about making sure their partners are secure too.
Exactly. The article really emphasizes that for an ISMS to be effective, it has to be tightly integrated into the organization's existing business processes and their overall management framework.
Right, security can't be an afterthought. It has to be baked into everything they do.
Exactly. ISO 27001 encourages organizations to adopt this integrated approach, and it provides guidelines for evaluating, treating, and reducing their information security risks.
Okay, so it's not just about checking boxes. It's about actually changing how they work.
Right. And these guidelines are often expressed as security objectives that are focused on the three core pillars of information security:
Such are.
confidentiality, integrity, and availability.
Okay, let's break those down.
Sure, confidentiality means making sure that sensitive information is only accessible to authorized people.
So like having strong passwords and access controls.
Exactly. Integrity means protecting information from unauthorized modification or destruction.
So making sure that data isn't tampered with or deleted.
Right. And availability means ensuring that authorized users can access the information and systems they need when they need them.
So the system is reliable and doesn't crash all the time.
Exactly. Those three pillars form the foundation of any effective security system.
Got it. So how does risk management fit into all of this?
Well, the article says that risk management is a key part of the ISO 27001 accreditation process.
Okay, so companies that want to be certified have to demonstrate that they're managing risks effectively.
Right. And the accreditation process has four main stages. The first stage is all about compiling the required documentation.
Like policies, procedures, and plans.
Exactly. And some of these documents are directly related to risk management.
Like what?
Well, there's the risk assessment and management plan.
Okay, so that lays out how they identify, assess, and manage risks.
Right. And it would likely include sections from the organization's broader corporate risk register, which outlines all the major risks they face across the entire enterprise.
Got it. What other documents are there?
The Incident Response Framework and Management Plan. This outlines how they'll handle security breaches and other incidents.
So they have a plan in place for when things go wrong.
Exactly. They can't just wait until something happens and then scramble to figure out what to do. And then there's the business continuity, crisis management, and disaster recovery plan.
Okay, that sounds pretty comprehensive.
It is. It covers how they'll recover from major disruptions, like natural disasters or cyber attacks.
So they can get back up and running as quickly as possible.
Right. And it's important to note that just having these documents isn't enough. Organizations also need to show that they're actually using them and keeping them up to date.
So they need to provide evidence that they're following their own plans.
Exactly. Things like training records, audit reports, risk registers, and records of follow-up actions.
Got it. So documentation is key, but it's not just about paperwork. It's about showing that you're actually doing the work.
Right. And the second stage of the accreditation process is to conduct a risk assessment.
Okay, so now they're actually identifying and evaluating the risks.
Exactly. And the article points out that this process aligns with the principles of ISO 31000, which is a general risk management standard.
Right, we've talked about ISO 31000 before. It's a really helpful framework.
It is. And it involves three main steps: identifying potential risks, evaluating their likelihood and impact, and then prioritizing them based on their severity.
Okay, so it's a systematic way to figure out what risks they need to focus on.
Right. Once they've identified and assessed the risks, the next step is to mitigate them. And ISO 27001 outlines 5 main categories of controls they can use.
Okay, let's hear it. What are the 5 categories?
First up, you have technical controls. These are the hardware and software-based security measures.
Like firewalls and antivirus software.
Exactly. Plus, things like backup systems, patch management processes, and secure configuration management.
So they're using technology to protect themselves.
Right. The second category is organizational controls. These are the policies and procedures that govern how people use and access information.
So things like password policies and access control lists.
Exactly. Plus, things like acceptable use policies, identity and access management systems, clear organizational structures with defined security responsibilities, and formal approval processes.
Okay, so it's about putting rules and procedures in place to make sure everyone is on the same page.
Right. The third category is legal controls. This includes things like non-disclosure agreements, security clauses in contracts, data ownership agreements, and compliance with all the relevant laws and regulations.
So they're using legal agreements and compliance to protect themselves.
Exactly. The fourth category is physical controls. This is all about securing the physical environment.
Like locks on doors and security cameras.
Yep. Plus things like alarm systems and access control systems. And the article emphasizes that these controls need to be properly documented and regularly reviewed.
So you can't just install a lock and then forget about it. You have to make sure it's still working and that people are actually using it.
Exactly. And the fifth category is human resource controls. These are the controls that focus on the people aspect of security.
So like background checks and security awareness training.
Exactly. They need to make sure their employees are aware of the risks and that they know how to protect themselves in the organization.
Right, because even the best technology in the world won't help if people don't use it properly.
Exactly. So those are the 5 categories of controls.
Okay, that's a lot to take in. But it seems like a pretty comprehensive approach to security.
It is. And the final stage of the ISO 27001 accreditation process is simply to meet the standard's mandatory requirements.
Okay, so there are certain things they absolutely have to do to be certified.
Right. Clauses 4 through 10 of the standard outline those requirements.
Got it. So we've talked about ISO 27001, which is a really big deal in the world of information security. What other frameworks are there?
Well, the article also mentions COBIT, which stands for Control Objectives for Information and Related Technology.
COBIT. Okay, what's that all about?
It's a framework developed by ISACA to support effective IT governance and management, and it's designed to be used by all kinds of organizations, not just IT companies.
Okay, so it's a broader framework than ISO 2701.
Yes, in a way, it's about making sure that IT is aligned with the business goals and that it's delivering value to the organization.
Okay, I see. So how does it work?
Well, it's based on 5 core principles. The first one is addressing stakeholder needs.
So making sure that IT is meeting the needs of everyone who has a stake in the organization.
Exactly. Employees, customers, shareholders, regulators, everyone. The second principle is providing comprehensive coverage across the enterprise.
So COBIT applies to all IT-related activities, not just specific departments or systems.
Right. It's about looking at IT holistically. The third principle is utilizing a unified, integrated framework.
Meaning that COBIT can work alongside other frameworks and standards.
Exactly. It's not meant to replace everything else. The fourth principle is promoting a comprehensive approach.
So taking a broad view of IT governance and management, considering all the different aspects.
Right. And the fifth principle is distinguishing governance from management.
Okay, so making a clear separation between the people who set the strategy and the people who execute it.
Exactly. And COBIT is supported by 7 key enablers.
Enablers, what are those?
There are things that help an organization achieve its IT governance and management objectives.
Okay, like what?
Well, there's people, policies, and frameworks. Then there's processes, organizational structures, culture, ethics and behavior, information, services, infrastructure, and applications, and people, skills, and competencies.
Wow, that's a mouthful.
It is. But basically, it covers all the different factors that contribute to effective IT governance and management.
Got it. So COBIT is a pretty big deal.
It is, and the article points out that it has a particular focus on security, risk management, and information governance, especially in the latest version, COBIT 2019.
So it's really aligned with the challenges that organizations are facing today.
Exactly. But the article also makes it clear what COBIT is not. It's not a framework for organizing business processes, managing IT operations, making specific technology decisions, or defining IT strategies or architectures.
Okay, so it's not a one-size-fits-all solution.
Right. Its sole purpose is to provide a framework for the governance and management of enterprise IT.
Got it. So we've covered a lot of ground here. We've talked about ERM in both the insurance and IT sectors. And it's clear that while these two industries are very different, they both face significant risks that need to be managed effectively.
Absolutely. And even though the specific frameworks and approaches they use might differ, the fundamental principles of ERM are the same: identify, assess, and mitigate risks.
Right. And I think what's really interesting is that as the world becomes more interconnected and technology starts to blur the lines between industries, we might start to see more convergence in how different sectors approach ERM.
Yeah, I think that's a great point. Like maybe insurers could learn something from how IT companies manage cybersecurity risks.
Right? And maybe IT companies could learn something from the rigorous risk categorization that insurers use.
Exactly. There's a lot of potential for cross-pollination of ideas.
It's definitely something to think about. So thanks for diving deep into ERM with us today.
Yeah.